Okay, so here's where we are. So this morning, the plan of attack is as follows. We're going to kind of finish up with handout 2, the introduction to real estate cash flow. Spend probably about maybe 30 minutes on that at the most, and then we'll migrate over to the new material for today on taxation. Spend a couple of hours on that, and then we will jump into quiz number 2 and then quiz number 3. So I can basically give you both of those quizzes at the same time, and you, in essence, can kind of allocate your time appropriately. But you've got obviously 45 minutes for each of those. Okay, and then after that, then we're done. Yep.
Can you solicit that when people finish the test, they leave the class and you kind of low down?
I'm sorry. One more time.
We can keep it quiet so other people can finish the test. Can we request that?
Chit chat while we were trying to.
Yeah, when we were finishing the test, there was a bunch of people talking and moving. Can we request them to kindly?
Yeah. Once you finish, you can get out of here.
No, I'm not talking about us. I'm talking about the people that are done to go ahead and leave, because we're going to be finishing.
Well, I don't think you have class this afternoon, so there's.
That's not what I'm saying, sir.
Okay.
I'm requesting silence so we can concentrate. The people that are finishing the test, they can concentrate. Because last time there were people chatting and talking and sitting around there, and that was disturbing.
Okay. Well, I mean that's
all
fine with me.
request.
Okay. All right. So once again, that's our schedule for today. Any questions? Yep.
For the quiz, is there any way that we can do some of the calculation in the computer?
No.
Okay.
No. All on the calculator. That's the way we're teaching it.
Okay.
Okay. All right. Because I purposely want you to become familiar with how to use the financial calculator. We're gonna use Excel later,
Okay.
but right now all using the calculator. Okay. All right. So to finish up, kind of some of the things that we've got with this first handout. Now, what I asked you guys to do was to obviously read through the second handout, kind of work through the questions and the problems there, and hopefully what you saw was pretty much what we covered, obviously in class, you know, at the kind of the last half of class last week. And so what we're going to do is kind of finish up with a couple of things that I didn't get a chance to quite get into, and do a few more calculations, and then we'll kind of move on. So one of the things that we need to talk a little bit about is dealing with growth rates, okay? And specifically growth rates associated with income and expenses, all right? So normally what you're going to have, you know, some sort of an income statement here. As we talked about last week, you know, we've got our potential gross income, our vacancy and collection losses, our other income, our effective gross income, total operating expenses, giving us net operating income. And so what we did last week was we pretty much calculated what those numbers would be for year 1. But we really did not get a chance to talk about what happens after year 1. In other words, what's going to happen in years 2, 3, and beyond, and how you go about getting those numbers, because chances are they're not going to be the same from one year to the next for a couple of different reasons, okay? So first off, just to kind of work through an example. So give me assuming that we've got a building that we want to do a quick little analysis on, give me the square footage of the building.
Professor, question.
Yep.
What is it called what you're explaining right now? What is it? What are we trying to?
We're just working with the income statement.
Okay.
Okay, so give me the square footage of a building. How much? 10,000. Okay, so 10,000 square foot building. All right. All right. And give me the rental rate for that building on an annual basis?
$10 a square foot.
$10 a square foot. All right. So that's going to make our calculations obviously very simple. So all we're going to have to do is multiply that 10,000 times the $10 a square foot, and that's going to give us $100,000 of potential gross income.
Excuse me, can I use one of your calculators? I didn't find mine at home.
Okay, so we've got $100,000 of income for year 1. Now, one of the assumptions that we may make as the owner of this property, or the investor in this property, or potentially the occupant of this property, is that that income is going to grow, or the rents are going to go up, all right? Now, as a practical matter, in many cases, this may be stipulated in the lease agreement. where you've got maybe an automatic increase in rents by a certain percentage each year, or it may be something that's tied to some sort of an index like consumer price index, or something else that ultimately is going to dictate what's going to happen to those basically rent rates. So what we're going to do is we're going to make the assumption that the rental income is going to grow. So rents will grow by what percent a year? Give me
3%?
3% per year. Okay? So if that's the case, what are we going to do to get year 2 and year 3? All right? It's fairly straightforward in terms of the math. All we're going to do is we're going to take that initial year income, and then we're going to multiply it by 1, which is multiplying it by itself, plus the growth rate of 3%. So that's the reason why 1.03. We've got to multiply it by itself, which is going to give us 100,000, but then also adding in that 3% growth rate to that. So what we should get whenever we do that math is 103,000. Does that make sense, everybody? Yes or no? All right, so that would be the number that we're going to pop in up here for year 2.
Professor, what do you have to multiply it by 1? I mean,
You have to multiply it by itself, because if you only multiply it by 3%, you're going to get $3,000.
oh yeah, like you add the 3%. That's
Right. Okay? This just saves a step. Okay? All right, now, for year 3, basically the same thing. You simply are going to say, all right, it's going to grow by another 3%. So you multiply the 103,000 times 1.03, and you get 106,090. Okay, so you get a little bit of extra in there. And the reason you get a little bit of extra is because you're obviously getting interest, in essence, on top of interest, if you sort of look at it from that perspective, sort of a compound effect. All right, so in this case, $106,090 will be year 3. Okay, everybody cool with that? Okay. Now, for vacancies and collection losses. Here, you can make the assumption that your vacancy and collection losses are going to stay the same from one year to the next. You can also make the assumption that they're going to change from one year to the next, okay? Those, once again, all of these things are simply assumptions, okay? Because let's just try to put this in perspective. You are either looking at this property to purchase, or maybe you own it and you're trying to forecast into the future, or you're the tenant and you're trying to figure out how much am I going to end up having to pay in rent. So all of those, reasons would be, the purpose for doing this. Now, you could also be doing this. Now, in this particular case, we're doing what is sort of a projected income statement, but we could also be doing actual numbers, okay? Which would be, okay, let's take the past 3 years and look at what actually happened in terms of each of these line items. But in most cases, what we're going to be concerning ourselves with in this course is more of a forward-looking projection of what those income and expenses are going to be, because that is going to help us determine what is the investment value for this particular piece of real estate. Does that make sense? Now, another sort of thing for you to put in the back of your mind. In many cases, when we do these kind of income projections, we're doing them over many years. Okay, and this one, yeah, we're only doing for 3 years just to kind of keep it simple and not get overly involved with a bunch of additional calculations we don't really need to do to explain what we're doing. But as a practical matter, you're probably at a minimum going to do 5-year projections and even more, and commonly 10-year projections. You usually don't do too terribly many beyond 10 years because it gets a little bit crazy to even think about what's going to happen 10 years from now. And part of the reason why you may do it over 5 years and you may do it over 10 years, a couple of reasons. One, lease terms. In many cases, the lease terms that you have with commercial tenants might be 5-year leases or 10-year leases, so it's a fairly easy thing to model if you actually, have those lease terms sort of locked in. Now, if you've got a 20-year lease, then sure, you can probably economically model what the cash flows are going to be for the next 20 years, and there's no reason not to. But if the majority of your lease terms are only 5 years, and you do a 20-year model, what you're going to have to start doing are sort of sensitivity analysis to say, well, what is the possibility that the renewal of that tenant 5 years from now is going to be the same lease rate? Is it going to be at a lower lease rate? Is it going to be at a higher lease rate? And a whole number of things. So another thing, just once again, to kind of put back into the back of the recesses of your mind, when you're doing these kind of projections, is that, think about it like this, it's almost like asking yourself, okay, you know how much money, let's say, you're going to earn as an individual this year. You have a pretty good idea of what your salary is or what your earning possibilities are for this year. But how easy is it really for you to project what you're going to be earning next year or 5 years from now or 10 years from now? It's a heck of a lot more challenging, yes? Well, the same sort of thing is true with real estate. The only thing that gives us a little bit more certainty, if you will, with the real estate is that we have that lease contract that's hopefully in place for a number of years that you may or may not have in terms of your own employment of a long-term contract. Does that make sense? Okay. So I keep saying this because all of these are just simply assumptions. Okay. And to a certain extent, you hope that your assumptions are valid. You hope that you're being reasonable, rational, conservative with your assumptions, because the last thing that you want to do if you're looking at this for the purpose of investing in this property is to overestimate what your income is going to be and to underestimate what your expenses are going to be. Quite frankly, you should be doing just the opposite. You should be saying, I want with absolute certainty to be as conservative as I can possibly be on income numbers and probably as liberal as possible on expenses, because that's probably going to be reality or closer to reality. I mean, it's an easy thing for me to say, it's a hard thing for you to do, because everyone, whenever they're looking at income properties to purchase, the biggest mistake that people make right out of the box is they get overly ambitious and overly kind of optimistic about what the income possibilities are going to be. Does that make sense? Okay. All right, so moving on to the vacancies and collection losses. Let's just say that we keep the vacancy and collection losses at a constant of 10%. Okay? So vacancies and collection losses, we're just going to keep that at 10%. All right, so in doing that, it's going to be $10,000 for the first year, $10,300 for the second year, $10,609 for the third year. Everybody see that? Okay. So all we're doing is we're simply applying the potential gross income, multiplying it by 10%, and that's going to give us our vacancy and collection losses for each of the years. Okay? All right? Now, other income. This is also something that can change over time. As we talked about last week, examples of other income, if this is a commercial property, it could be we're having people pay for parking, it could be we're having them pay for signage, it could be, a whole number of other non-rental related sort of income that the property could be generating. So, and it also could just be zero. We could have no other income on the property, all right?
So, would you kind of hedge other income and operating expenses because they're going to offset each other with inflationary?
You could. I mean, once again, all you're trying to do is do your best interpretation of reality, of what you think reality is going to be. That's all you're trying to do. And 10 of you could be looking at the same identical property, and you may come up with 10 different scenarios as to how that property is going to play out over the future based upon what your assumptions are. okay? Now, if I give you, which is what the case is with like a class exercise, if I give you all the assumptions, yeah, there is only one way for it to work out. But, you know, in reality, you're gonna have to make certain assumptions as to whether or not that's a valid assumption or not, okay? All right, so in this particular instance, we're just gonna assume there's no other income, all right? The property is generating, so all we're gonna do is simply subtract out the vacancy and collection losses across the page. So we end up with 90,000 for the first year. $92,700 for the second year. And $95,481 for year 3. Okay? Make sense? And all we're doing is just subtracting. All right. Now, operating expenses, and this is part of what Noah was talking about. Operating expenses inherently are probably going to increase most every year, okay? And some things you have control over, some things you don't. One of the things that you don't have control over that can be a real mess, depending on where you're located, within the country, are property taxes. Not income taxes, but property taxes. Because it's totally out of your control, in the sense that you bought a property, let's say for $1 million, and it was put onto the property tax rolls at $1 million, and let's say the tax rate was like 3%, okay? Well, 3% of $1 million is what? 30 grand, yes? Okay, so you have a 30 grand just property tax expense maybe in year 1 on your property. Well, what happens if the local government decides they're going to raise the tax rate? You have no control over that. So it goes from 3% to 4%. All of a sudden your tax bill goes from $30,000 a year to $40,000 a year. You've had no control over that. Okay? None as a property owner. Now, yes, you can go protest your value of the property, but usually that value is going to be based upon what is the current market valuation of the property. And if you just bought it a year ago for $1 million, chances are they're going to say, look, you only bought it a year ago, you paid $1 million, it hasn't really probably maybe gone up or gone down that much in value over that year. Now, you could make the argument, well, maybe the market is going down, and you might be able to get the value reduced. So you would have some control over that, but you could also have the other phenomenon where all of a sudden the market blows up in a big way. I mean, imagine if you had been in Wynwood, a couple of years ago, and you had bought properties, let's say, at $1 million on the tax rolls, and now, all of a sudden, just a few years later, those same exact properties on the tax rolls are maybe $5 million. Okay? Well, yeah, the property value has gone up from $1 million to $5 million. Your tax in terms of property tax, which was 3%, went from what, $30,000 a year to $150,000 a year. You follow? You had no control over that. Now you're saying, well, oh, that's great, my property is worth so much more. Well, yeah, your property is worth more, but what does that mean you're probably going to have to do? Raise rents in order for the property taxes to be paid. Do you follow me? Okay? So my point with this, that's just one example of many, that your operating expenses to a certain extent are out of your control. The ones that you can control are what? Things like repairs and maintenance, to a certain extent. I mean, you've got to fix stuff that's broken, or at least you should, and if you don't, well then you're probably going to have tenants moving out on you because things aren't fixed, and obviously they're going to stop paying you rent, whatever it might be. So anyway, just keep those things in the back of your mind. Okay, so operating expenses, we could handle it one of a couple of ways. We could just simply say, operating expenses are going to be a fixed percentage of EGI. We could also say, operating expenses are going to be a fixed percentage of PGI. What would be the difference in those two? approaches.
Employee vacancies.
So if we were to fix it based on EGI, what we're saying is their operating expenses are going to vary depending on occupancy level. Okay, does that make sense? In other words, if our occupancy is low, our operating expenses are going to be low. But if our occupancy is high, our expenses are going to be high. But if we base them strictly on PGI, as a percentage of PGI, then what we're saying there is the occupancy of the property really doesn't matter whenever it comes to what our actual operating expenses are. Okay, now we could get much more sophisticated than that. We're not for this sort of exercise in this course, but we could sort of say, okay, there are going to be certain expenses that are going to be variable based upon occupancy, and then there are going to be other expenses that are going to be fixed regardless of what occupancy is. You follow? Just logically. So we could also just simply say, okay, for the first year, we estimate it to be a certain dollar amount, and then we could say from that point forward, it is going to, maybe those expenses are going to grow, much like the income does, by some sort of a predetermined growth rate. What I'm trying to express to you here is there's more than one way to approach kind of this modeling, okay? There's not an absolute. Now you're going to be told, once again, in a problem or in a case study or that sort of thing, here is the way to treat it. But I'm trying to give you a couple of different ways to sort of look at it. All right, so let's just say I'm just going to pull out of the air $30,000 for the first year of operating expenses. So $30,000, so basically, a third of your EGI is going to be based, or is going to be your operating expenses for that first year. But I'm going to say, while I've given you that as your base assumption, we're going to make the assumption that total operating expenses are going to grow by a fixed percentage. And let's say they're going to grow by a higher percentage than your income, okay, which can happen. So let's say that operating expenses grow by 5% a year. Okay, so that means as we go across here, it's going to grow by 5% a year. All right, so doing the math on the operating expenses, we have $30,000 in the first year. To see that grow by 5%, we're simply going to take the 30,000 times 1.05. And we get 31,500 for year 2. Okay? Does that make sense, everybody? Okay, and then we do the same thing for the third year. It's also going to grow by 5%. And we end up with 33,075. Now once again, with our simple little analysis here, we're keeping those growth rates the same from one year to the next. They don't have to be, okay? Once again, just depends on what the assumptions are that you're given. I mean, it could have been the case that we grew this one by 5%, and then we say, well, we really expect some major, tax upheaval, so this might have to go to, 8 or 9%, But for this particular example, we've made the assumption they're going to stay the same. Okay. Now we do the basic math to get our NOI. Okay, so for the first year, 60,000. $61,200. And 62,406. Okay. Everybody cool with that? Any questions? Okay. Now, let's let's talk a little bit more about the cap rate as it sort of applies to some of this. All right, if you remember from last week, we talked about the cap rate, we talked about ERV. All right, and so if we sort of said that with this particular property, we've never talked about what the value of the property was or what the cap rate was, okay? So, just to kind of illustrate something here, if we have a cap rate that we're gonna, let's just say, put in here, and that cap rate were to stay constant at 10% across the page. All right? So that means that our income for that first year is $60,000. Our cap rate is remaining constant at $10,000. So that means that our valuation for the first year would be $600,000. Does that make sense, everybody? Yes or no?
Yeah.
Okay. So for the second year, would be $612,000. And then for the final year, $624,000. Okay? From a very simplistic basis, okay, what we're saying is, all right, the property is growing in value each, and there's a reason why I'm doing this, okay? It's a very simplistic sort of analysis, because the assumption here that I'm trying to get you to make sure that you see, it's a very simple one, and that is, as your income grows, so does the value of the property. Okay? Now that's pretty simple, but here's the point that I'm trying to illustrate here. For every dollar extra that you can generate on this property in terms of net operating income, what effect does that have on the value of the property? So if I generate one extra dollar a year in net operating income off of this property, what impact does that have with a 10% cap rate? But how much? This is what I'm trying to get you to wrap your head around. It's very simple. It's going to go up by, what'd you say? $10. Okay? Look, this is probably one of the most important things that I can probably stress, because once again, look at this. This is why it's beautiful. $1 of extra income a year with a 10% cap rate means a value of $10. So that means that's $10 more someone will spend on your property if you can generate one extra dollar of income a year off of that property. In other words, in terms of the selling price of that property, the investment value of that property. So this is why we start talking about things like the marginal contribution of income, okay? In other words, think of it like this. Let's say that you're in the luxury apartment market, okay? And as a developer, as an investor. And I remember, and I used to bring one of these to class to sort of, show as an example, but these sort of luxury apartment developers, in many cases, they would have these surveys that they would do of their current occupants to kind of help them think about how they would potentially develop future properties. And so they would give these surveys, and they would say, how much extra would you be willing to pay per month to have fill in the blank? Okay, now those things might be, how much more would you be willing to pay to have, I don't know, stainless steel appliances? Or how much more a month would you be willing to pay to have granite countertops? How much more would you be willing to pay to have crown molding? How much more per month would you be willing to have an upgraded carpet? How much more would you be willing to pay to have French doors? How much more would you be willing to pay to have a big balcony? How much more would you be willing to pay, you know, just, I mean, it's almost like endless, the sort of upgrades that you potentially could do. Now, you're saying, okay, well, so what? Well, the reason for them asking that question is fundamentally tied to this, because what they're basically saying is, if you're willing to pay $10 more a month in your rent, that translates into what per year? $10 a month times 12 is $120 of extra income. Yes? Okay. So if that means they can generate $120 of extra income a year off of that little upgrade, how much does that mean they can spend on that upgrade? $1,200. Well, what if the upgrade only cost them $600? That's a home run for them. You follow? If they can spend $600 on that upgrade, and you're willing to spend an extra $120 a year on your rent, then they, in essence, created value out of thin air to a certain extent of an extra $600. Does that make sense? Okay, this is precisely the sort of thing that investors and developers constantly think about, is what is the marginal benefit or the marginal contribution of that feature to the property. Okay, and this is a fundamental sort of valuation sort of thing. Now, one of the things that you may have heard about, and we don't really get into this because we're not really, once again, overly concerned with the appraisal side of the business per se, but appraisers typically use what is called a hedonic pricing model. Have you ever heard that term before? Ever heard of it? Okay. Well, if you think about it, you think of the term hedonic, okay? What is the first thing in your mind that brings up? Hedonism, yes? Okay. Well, what is hedonism? Pleasure, okay? Well, think about it. The valuation model, to a certain extent, is how much value are you attributing to each individual thing that gives you some sort of pleasure or some sort of value in the property. What you begin to do is you begin to isolate each of those individual variables and say, what is the individual contribution of that extra bathroom, that extra bedroom, that extra, big balcony, that extra, view, that pool, that whatever else it is. And each of those items has some sort of a hedonistic value contribution to the property. Does that make sense? Yes or no? Okay, so what we're trying to do, however, on the developer side of the business and the investor side of the business, is think about, can we buy this property and in essence put in new features, possibly, to this property that will increase that underlying income to create value, okay? The simple thing that, obviously the obvious thing that everyone thinks about is, what can we do to raise rents? But you can only raise rents so high because they're market driven. But how do you potentially get them beyond what the market is? Well, you deliver a product that does what? Has features that the market doesn't currently provide, so therefore you can achieve higher rents. Does that make sense? Which is going to translate into more value for you as the investor or developer. Is everybody clear on that? Okay. Yep.
How would a question be phrased? Like, for example, like a test question. You would say, how much value would X amount of dollars income
Translate into? Sure. It's very simple. Okay. I mean, another very basic example. Imagine doing this on large scale. One of the most common examples of this that was done back in the early 90s, whenever apartment developers were starting to really build the renter by choice kind of apartments, was putting in covered parking. And in Texas, this was super popular to have covered parking for one very simple reason: hailstorms. Okay, and the sun. Okay, But hailstorms being one of the big ones, because every so often, unpredictably, you're going to get a hailstorm and some, stones falling from the sky that are sometimes the size of baseballs or grapefruit. Your car will be decimated. Okay, so they would say, okay, how much are you willing to pay extra per month to have a covered parking space, just a carport covered parking space? And what they found was that most people were willing to pay an extra $25 a month for that covered parking space. Well, once again, let's do our simple math here. $25 a month translates into $300 a year, okay? $300 a year with a cap rate of 10%, $3,000 per unit. Well, once again, if they can build a carport, which is nothing more than a few poles in the ground and basically some sheet metal, okay, and they can do that for something less than $3,000, which they were able to do it maybe for $1,000, it's a home run, especially if you're talking about hundreds and hundreds and hundreds of units. You have instant value creation. Okay, make sense? Okay. All right, moving forward. Okay, one of the other things that we sort of talk about with cap rates is a going-in cap rate versus a terminal cap rate. Okay, have you heard that before? Okay, so more of you have heard that term before. The going-in cap rate is the one that happens whenever you're buying the project. What is the cap rate for whenever you buy the property? And so in this case, we've said that they're all the same, but what if they weren't the same? And we're going to sort of ignore the one here in the middle, and we're going to focus on year 3 here for example. All right, so we go in, we buy the property with a going-in cap rate of 10%. And as an investor going into the property, especially if this is a property that we are repositioning in the market to be a higher quality product, to obviously generate more in rents, yada, 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 make it more stable, secure, that sort of thing. Theoretically, what would you expect to be the case on your terminal cap rate or your reversion cap rate?
Expect it to be lower.
You'd expect it to be lower. Why? Because hopefully you have reduced the risk associated with the property, and you have stabilized and possibly even increased the rent on the property. Does that make sense? So what if instead of a 10% cap rate for the terminal cap rate, you were able just to lower it by 1%. We're not going to get greedy. We'll just say lower the terminal cap rate to 9%. What's the impact that has potentially on the sale price of the property? Well, it's going to raise it. So instead of being $624,000, it's going to be worth $693,400. Does that make sense? Because what we've done is not only have we increased the revenue, but we've lowered the risk associated with the property, so we have a double benefit, is what I'm saying. Which is a great and wonderful thing if you can achieve that. Okay? Because now, all of a sudden we have a property that we bought for $600,000 and we're selling for $693,000. Now, that's only part of the story. What we don't know within this analysis is, did we have to make some capital expenditures along the way to achieve that? Okay? Which is, in other words, we had to spend some money in order to possibly get that higher level of income and to potentially reduce the risk. Not necessarily. In some cases, we need to do a better job of managing the property. Okay? without having to spend any extra money to achieve that. Yep.
Wouldn't we have to actually use the 9% of year 4?
In this case, we're just sort of saying, what would the value be in year 3? I understand, and I'm about to get there. What Noah is referring to is we typically apply the cap rate to the income that we expect to be generated by the property 1 year from today, okay? Or 1 year from the end of our analysis, okay? So, in essence, what we're really saying with my little analysis here, that's the reason I kind of skipped over year 2, is that we're saying right here at time period 0, this income is occurring 12 months from now. Okay, is everybody clear about that? End of year 1, okay? We are sitting at time period 0. This is happening over the next year, so this is the value at the end of next year, $600,000. Okay, so the value that we would use at the end of a year from now, if we were standing here 1 year later, then we would use this value. Standing there 1 year after that, we're going to use this value, and so forth, so on. It's always going to be pushed out potentially 1 year, because the income approach to value is based on the assumption that it is forward-looking, okay? That it is a value determined based on future income. Okay, even if that income is only a year into the future, because it doesn't make any sense to value based strictly on the operating history of the property. I mean, it's good to look at, but what they did last year may help to inform what the possibilities are for next year. But the reality is, last year should stand on its own. What we're really concerned about with is how is it going to perform this next year.
So what you're saying is, if we do some capital expenditure on year 3, you will plug it on year 3, and then you will calculate.
Yeah, I mean, there will be some expenses that you're going to have to account for. But in this particular example, we're just going to assume there aren't any. We're going to get to that a little bit later. Okay? But up to this point, does everybody understand? Okay. All right. Let's see if there's anything else here. All right, let's just do a quick little sort of kind of NPV on this, an IRR. All right. And so here's what we're going to make the assumption. Well, actually, let me leave that up. I'll just do it on the chalkboard. Okay. All right. So, for this particular property, let's say that at the time we purchased it for, let's say, $500,000, okay, was what we bought it for at time period 0. So we bought it, in my mind, as one payment per year. We bought this property at what I would call kind of a bargain basement price. Because what we're saying is, if I paid $500,000 for it, and really, at the end of this next year, it's really going to be valued at $600,000. I got a great deal on it. Okay. Now, how did I get such a good deal? Could be a whole number of reasons. Maybe it was a foreclosure sale. Maybe it was somebody who had died or got a divorce, or whole number of other things that potentially could be negative kind of things that cause you to find an undervalued property. So $500,000. That's what we paid for. Now, in this particular case where there is no debt affiliated with this property, it is purely, we're making the assumption I paid $500,000 in cash for the property. Is everybody clear with that? Okay, so that means at the end of the first year, my income on the property was $60,000, net operating income. Everybody see that? So that would be the cash flow for that year. For year 2, $61,200. Everybody see that? Okay. end of year 3, we're going to get the 62,406 plus whatever assumption that we make about what the value is of that property at the end of that period. Now, once again, this particular analysis is ignoring, first of all, there's no debt, so we have no loans we have to pay off. Also, we're ignoring any income taxes on the sale of the property, which that's our next topic to get into. But right now, we're saying strictly cash in, cash out, what would we potentially be able to sell this property for? Well, that all depends on the assumption that we want to make about the property and what the income is potentially going to be, not necessarily here, but potentially 1 year into the future. And so we might actually have to project this out a little bit further. But let's just assume for the moment, we kind of say, we think we can probably sell it just looking at these numbers and maybe make, and say, okay, we hope we can get more than this. We may not be able to get all of this, so we may kind of split the difference. I'm just kind of pulling out of the air and say 650,000. Okay? Just making that assumption. All right? So we do this. All right? So the first thing we want to do is to say, all right, what is the internal rate of return on this property? In other words, just an annualized rate of return.
20.42.
Okay, I'm just going to trust you, but I'm going to double check. You are correct on. Okay, so 20.42 is the internal rate of return. Now, if you're not getting that, one of the reasons you might not be getting it is because you forgot to change the calculator to 1 payment per year. If you have it set for 12 payments per year, that's not going to give you the right answer because that's assuming these cash flows are monthly, okay? And these are annual, okay? Now, once you've got that, what is it telling us? That's telling us, as the investor, if we had written a check, cash money, for $500,000, our annualized rate of return for a 3-year, 36-month, or 3-year really holding period was 20%. Does that make sense, everybody? Yes or no? Now, what if I said, in order to do an investment, my company has a minimum hurdle rate of 15%. A minimum hurdle rate of 15%. Should I do this investment? Yes or no?
No, we want to increase the property value. You want to.
Okay, once again, listen to what I just said. If my investment team, I have a minimum hurdle rate, meaning I must achieve 15% or higher on any investment that I do, should I do this investment? Yes or no?
Yes.
Yes, because 20% in most of the time is greater than 15%. Okay? So the overall rate of return of 20% is greater than my hurdle rate. I mean, hurdle is just like in running. You jump over a hurdle, yes? Okay? Well, so the idea, and investor sort of way of talking and thinking, the hurdle is simply a number that you've got to get over. As long as your rate of return is greater than that hurdle rate, everything is good. Now, if my hurdle rate as an investment team was 25%, would I do this investment? No, because I didn't meet the minimum threshold. I would have tripped over the hurdle, so to speak, okay? Would not have met it, all right? Now, what if my hurdle rate was 20.42? Just making it a very precise hurdle rate. Would I do it, yes or no? I would be indifferent, okay? Because if it's precisely my hurdle rate, it's kind of like, yeah, I'm getting over, but just barely, and because here's what potentially maybe is going on in the back of my mind. Yeah, it's met my hurdle rate, but am I completely 100% comfortable with all of my assumptions? Okay, and that's the part that begins to be a bit more messy, because you change one teensy little assumption and all of a sudden that changes. So this gets back to what I was talking about earlier in terms of being conservative with your assumptions, because that matters. And that's why I use the example of, well, if it's 25% or if it's 15%, because there, it's pretty obvious, unless we made some gross miscalculations, we're going to be in okay territory in terms of either accepting it or rejecting it. But if it's right there at it, we have to be a little bit more cautious. Okay. Any questions about that? Yep.
You said at 25 you would?
At 25, if your hurdle rate is 25, and it's only generating 20.42, you would not do it.
Oh, no.
Because it hasn't met your required rate of return, your hurdle rate, as an investor. Okay.
Do you mind if we run a quick calculation on the calculator to have the interest, the rate of return to be 25 to see how much will be the purchase price?
We can do that, okay? But before we do that, we're going to do it the other way.
Okay.
We're going to say, what if we were to simply set our hurdle rate at 15%? We know it is meeting and exceeding our hurdle rate of 15%, but what we want to know is by how much, okay? And that's where net present value comes into play, okay? So we've calculated internal rate of return, so what we're going to do now is we're going to replace the interest rate with the hurdle rate of 15%, and then we're going to solve for, and actually, hold on, well, we'll come back to it. Okay, so we're going to solve for net present value. So let's do that.
15 with the 50%.
And you get a net present value of $66,868.41. Okay? Now, many of you are going to be looking at that number and you're going to say, well, what does that number mean?
Is what the property, what is the cost of the property at the moment, right?
No. Okay. What the net present value number is telling us in this particular circumstance is it's saying listen to me, we could pay an extra $66,868.41 above and beyond the $500,000, and we would still meet our hurdle rate of 15%. That's what this number is telling us. The net present value, because it is subtracting out the $500,000 that we've already invested. Okay?
Can you repeat what it does?
Okay. Once again, the net present value is simply telling you how much more, in this particular instance, you could pay for the property up front and still meet your required hurdle rate of 15%.
Basically, 500 plus the 66.
Yes. So another way of looking at that from a very practical sort of perspective is you could say, we could spend more to buy the property up front, but this also, in another way of looking at it, is we could use this money on renovations to the property and still meet our required hurdle rate. Okay? Now, if we put in 20.42 as our interest rate, which happens to be our internal rate of return, and we now solve you should get something pretty close to zero. Okay, let's do it myself. You get, well, you get like
$2.
yeah, $2, not 2%, but $2.93 as your net present value. And that's just because of rounding. It really should be zero. Okay? Now what that's telling us is if our hurdle rate is the same as our internal rate of return, then in essence, our net present value is zero. Meaning we can't spend any more on the property or any less on the property in order to get that rate of return. Does that make sense? Okay, because that is the return the property is actually generating. Okay, now the final piece is what you were suggesting, which is what if we go to a 25% hurdle rate and we solve for net present value. What's different about this number? It's negative. Negative 48,080.13. So what is that telling us? That's telling us we shouldn't do this property because we have a negative net present value, but we could do it if we were to spend $48,000 less than $500,000. Does that make sense? Then we would at least break even. Okay, does that make sense? All right, so that's the whole role of the net present value is it's a way to sort of show you what would be, how much more you can either spend on the property or how much less you should spend on the property up front whenever doing your analysis. Okay, make sense?
If I plug zero in the first, instead of the 500,000, if I plug zero and then I do
Yeah.
the...
If you were to plug in zero up here, okay, then what you would find is it would take, this would become 566,000. This would become 500,000, roughly. And then this would be something, you know, probably about 452,000, roughly.
Can you restate that last sentence with respect to the $48,000? If you get that negative, you can spend as much.
In other words, instead of spending $500,000 on the property, you could only spend $452,000 on the property. That's $48,000 less than the $500,000 that you did spend.
So basically, you would not purchase that property for $500,000.
Correct. You would have to get a better price on it in order to purchase it. So this is where that, once again, depending on what your hurdle rate is as an investor, your hurdle rate may be different from another investor. So this is what you always kind of wonder, well, how is it these people are able to afford it and I'm not? Or my company is not? Because their hurdle rate may be different than yours. Their assumptions may be different than yours. Doesn't mean their assumptions are right. This means that they're different. Okay? Because what happens, I mean, you would be surprised, and this is the part that sort of blows your mind, is that you've got some very highly paid people that are sitting around coming up with these value estimates, in many cases in an office somewhere, and not really fully understanding the underlying physical, locational, sort of site-specific attributes that a property has, and are in some cases overestimating what the value might be, and in some cases severely underestimating what the value might be. Okay? Hopefully you, being maybe more on the ground, you might have a better sense of, are these numbers realistic? Okay? All right. Any questions before we move on to tax?
Why, when I do zero and then the calculation and then I try to calculate the internal rate of return, it's giving me no solution?
You've got to make sure that,
Plus or minus.
once again, in this case, if you enter the zero, it doesn't have to be plus or minus zero, you just have to enter zero as the initial cash flow. And then you're going to solve for, once again, as a 15% rate of return, what your net present value would be. It should give you $566,000. Okay? All right, let's move forward.
It has to put maybe one in the first one?
All right. Everyone's favorite topic, income taxes. All right. So, get back to my.
Professor Forty,
Yep.
one question. What if you did the capital expenditures and not all units rented at the market rents, but all of a sudden the market,
So you don't invest in
I mean the caps in the market go up, meaning that properties are losing value?
Yes,
That could happen, right?
absolutely could
It
happen.
doesn't affect your price when you sell
Absolutely
property.
affects your price. You know, and so that's the thing, that these numbers don't inherently stay constant over time. They fluctuate. Cap rates fluctuate, values fluctuate, income fluctuates, everything fluctuates. And what you hope, as a general rule, is you hope for a stable, you know, predictable sort of market for your holding period. Sometimes you get lucky, and that's exactly what happens. But in other instances, you buy it with investment-backed expectations that it's going to do this, and instead it does this. You know, all I can say to you is that, you know, it's the old adage of, you know, as an investor, you want to do what? Buy low, sell high, okay? But what if you buy high, and then you're forced to sell low? You've destroyed a lot of value very quickly. Okay, and that happens more often than not, you know, with real estate investments, because right now is probably the worst possible conceivable time to be buying real estate. Okay,
You mean in all the asset classes, or just
most
one?
asset classes, with the exception of industrial, but most asset classes, because residential is getting way overbuilt. You've got retail that's dead as a doornail and getting worse. You've got office that's also, for the most part, kind of a dying sort of use, even though, you know, there have been a few little adjustments there. But but industrial, I mean, obviously you've got more and more delivery services that need places to park their products close to their consumers. So, you know, there's opportunity there. But as a general rule, right now the market is, in my mind, without question, at an absolute peak, and has already dropped off a little, certainly on the residential side, and there's more potentially to come. And it's been a nice little buildup over the past several years. Right now is the perfect time to sell. Okay, if you're an owner, now is the time to sell, without question. You know, because it's not going to get much better than this. It might get a little bit better, but there's too many things that would lead me to believe that, you know, it's a disaster in the making.
Right. But it's also an opportunity for the person that is looking to buy low, right?
Absolutely.
And then reposition
Yeah.
that
But
property.
once the market begins to, you know, or not just begins, but once the market kind of is, you know, just gone down the roller coaster and we're down in the bottoms again, then, you know, time to get out there and get involved. Okay. All right. So out of chapter 11, if you spent a little bit of time reading this chapter, I mean, the first little bits and pieces we're kind of talking about, you know, kind of some market analysis stuff, that's all fine and good. That's, you know, kind of investment strategy, a few other little things like that. We can talk a little bit about that. But the most important thing out of this chapter, without question, the part we're really focusing on is taxation. Okay? And some of the things that you need to be aware of as it relates to income taxation of real estate property. And this is where it matters what your tax rate is. It matters what your ownership structure is. It matters who gets paid, when they get paid, how they get paid. All of that now really matters, okay? Up to this point, what we have done in this class and what we spend all of our time on in the real estate finance class is everything up to before tax cash flow, okay? Getting, you know, down to net operating income and then down to before tax cash flow. In this class, it's about everything beyond that, okay? So specifically, if we're going to kind of look at the income statement, you know, we had PGI minus vacancy and collection losses plus other income gives us effective gross income minus total operating expenses gives us net operating income minus annual debt service gives us before tax cash flow, okay? That's where we have spent all of our time up to this point. Now, this next piece, I'm going to draw a line here for a moment. We have to do what I call a tax subroutine, okay? Those of you that are computer programmers, you can really kind of relate to that because what you have to do is kind of back out of the model for a second and do something, a specific set of calculations strictly for tax purposes. And those calculations are to sort of restart with NOI, subtract out interest expense, subtract out depreciation, and that is going to give you taxable income. You're going to multiply that by a taxed rate, and that's going to give you taxes payable. Okay? And then we draw a big line again. Okay?
Sorry, I
So-
got lost after depreciation.
So net operating income, you subtract out interest expense on any mortgage. Not subtract out the debt service or the mortgage payment, just the interest piece.
That's my question.
I'm sorry?
That's my question.
Okay.
What's the difference? When
Okay.
do I subtract the debt
We're getting there.
Okay.
Okay. The annual debt service, which is the number up here, that is your total mortgage payment, principal and interest. Okay? In other words, when you make a mortgage payment of whatever that is each month, part of it is going toward the reduction of the loan amount, which is the principal amount. The other part is going to pay interest on the loan, and only the interest portion is tax deductible. The whole payment itself is not tax deductible, just the interest portion. And we're going to work through examples, okay? Okay.
My question is, what's the meaning then of before tax?
Before tax cash flow is just simply taking your net operating income, which is the property's income each year, and then you subtract out your mortgage payment to give you what is your actual cash flow, the real hard currency that you have to then pay your taxes payable. We're getting there. Okay? This piece, that's why I draw a big line. This piece is sort of, it's a subroutine. We're sort of like starting over now with NOI, subtracting out interest, subtracting out depreciation to give us our taxable income, to multiply by our tax rate to get taxes payable. Okay? Let me finish this and I think it will become clear. Once we have completed this subroutine, then we go back to our before tax cash flow and we subtract out taxes payable. And that gives us the number we've really been waiting for, which is after-tax cash flow. Okay? So, the point here, and this is the most common mistake that people make, people automatically assume, all right, you take before-tax cash flow and you subtract out taxable income, and that gives you after-tax cash flow. No, 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 no. You do this to figure out what your actual taxes payable are. Okay, now let me try to we'll put some numbers up there, we'll explain it much further, but just follow with me here for a second. Because we haven't talked about how do you get that interest expense number. We haven't talked about how do you get that depreciation number. We haven't talked about the tax rate yet, okay? What I'm doing now is just simply saying, here is the format for the income statement, okay? These are the line items, okay? Now, if we think about this just for a moment, and this will become much clearer here for a moment. And I'm not exaggerating, I am not making up what I am about to say. Listen to me. The tax world is not the real world. No, 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 I'm not joking, I'm not exaggerating. The tax world is not the real world. The tax world is a regulatory world. It is a world made up of rules and regulations and procedures that are meant to collect and to determine what taxes are. They are not inherently rational. They are not inherently reasonable. They are not inherently obvious to the casual observer. They simply are what they are. Okay, does everybody follow what I just said? Okay? Now, the reason I say all of that, and you may sit there smirking and saying, yeah, whatever. The reason I say that is because these calculations that we're going to be doing, you're going to scratch your head and you're going to say, what? Why? This doesn't make any sense at all. I don't understand why you would do that. That doesn't, you know. Okay, that's what I'm saying. You've got to remove that part of your brain whenever we start to talk about taxation. I will try to make it as realistic and as honest and as direct as possible, but there are bits and pieces of this that, yeah, you're going to scratch your head and you're going to say, that really doesn't make any sense to me at all, okay? And that's okay, just understand it, okay? That's the preface. Okay, now, the real money that a property is generating, if you think about this from a bank account perspective, so far I haven't put any numbers up here on purpose because I want you to think about what's actually happening here. In terms of real cash money that is sitting in your bank account, the maximum cash money that you would ever have sitting in your bank account from this property would be at what point along this line? Now, listen to the question I just asked. At what point on this income statement would you have the most money, actual, real, hard currency sitting in your bank account? At what point on this? Which line item? EGI. Remember what I said last week? PGI is the potential. But you've got to subtract out the vacancies and the collection losses, so the real hard currency sitting in your bank account is going to be EGI. Okay? From the EGI, you actually make cash payments to all of your vendors, all of the people in terms of operating expenses and salaries and whatever else you've got to pay. So that then leaves you with net operating income. The net operating income is the money you now have available to do what? Pay your lender. Okay? So you pay off your lender the annual debt service. So now, after you have paid off your lender, you are left with before tax cash flow. Does everybody follow that? Okay, so that is the hard cash currency you now have in your bank to pay who? Two different entities. One, the IRS, and two, your business partners or investors. Okay, so the next set of calculations that you're doing here are to calculate what are the payments I'm making to my not investors, to the IRS, taxes payable. Okay? Now, this is the part that begins to get a little bit weird. Okay, so what we have to do is we have to jump back up. That's why I put a big line here. Make it bigger. Because this is what I'm referring to as our tax subroutine. So we have to go back up and we have to recapture whatever our net operating income is. Because the whole purpose of this calculation, the whole purpose is to calculate just the taxes payable. Nothing else. Nothing else. Okay? So, what we do is for the taxes payable, we have to go back up to net operating income, get that number. Now, this is where we start applying the tax law. The tax law. Number one, only the interest on your mortgage is tax deductible. Only the interest on the mortgage is tax deductible. And that's true whether you're an individual or whether you're a business. Only the interest is tax deductible. All right? So, we will get around to what the actual numbers are and do the calculations on that here in just a minute. Okay? Noah?
Yeah, I was gonna say, are we gonna actually amortize?
Yes. Okay. So this is only the interest portion of the mortgage. Okay, everybody cool with that? Okay, now this next one. This is where people's heads blow up, okay? This is when we start talking about depreciation and what it is. The IRS, many years ago, specifically, I think it was around 1993, well actually and before that, 1986, were the last two times they made any radical changes to the tax laws that really affect real estate, for the most part. Made some little capital gains adjustments a few years ago, but for the most part, for depreciation, it's been the same since the early 90s. And the way that it works is as follows. If you have a residential investment property, the depreciable life is 27.5 years. If you have a non-residential or commercial property, the tax life is 39 years. Now the first question out of your mouth is, why aren't they the same? Second question out of your mouth is, why 27.5 years? Why 39? Where do these numbers come from? Any idea? Congress. Congress says residential property should have 27.5 years of life. Is there any reason, rationale to it?
Well, you live in your house and most of the people have their equity in their homes.
Yeah, but see, that tax law, that's for single-family residences that live there. This is for investment property.
Oh, for multifamilies?
For multifamily, or if you own homes as an investment property.
Right.
That's the only time this matters. Now, one could make the argument
The useful life of a roof.
that you can make an argument and the argument that they made, you could argue with it, is that residential homes, because of the nature of the construction of those homes, whether it's single family or multifamily, especially 2 or 3, 4 level sort of, stick-built construction, like we have in Texas, not here in Florida, that the useful life might only be around 20-something years, okay? But for commercial properties, you tend to build them at a higher standard. At least in Texas you do. Here, no, and I mean it in a good way, because here, because of hurricanes, what do you have to do? You have to build residential properties to withstand quite a bit, which does what? Drives up the cost of those homes, but it also probably extends the useful life of those homes because it's a bunch of concrete masonry units that have been put into place. Whereas in Texas, it's basically, it's all just 2x4s and, you know, sheetrock with a little bit of, you know, cladding on the outside that it won't stand up to a hurricane, okay? So that's going to be a lot less construction cost, but also probably a less sort of time horizon that they will survive, so to speak. But this is part of what I'm talking about. Tax world versus real world, two different things, okay? The tax world is simply saying that for the purposes of depreciation, you have 27 and a half years for a residential property, and for a commercial property, non-residential, which would be things like office buildings, retail buildings, industrial buildings, 39 years. Now, the question Noah maybe is about to ask is, well, what about mixed use? Okay? Mixed use properties, if I don't want to lie to you, my brain just flipped whether it's 80 or 75%, but I think if it's greater than 75%, and maybe 80%, and you're not going to be tested on this obviously, but if it's greater than, I think it's either 75 or 80% residential, the whole building can be claimed as residential, meaning you get a quicker depreciation for your commercial piece, which is a good thing. Because you're saying, well, wait a second, do I want more or do I want less? You know, which one is better? Well, for tax purposes, you want a quicker depreciation term. You want to be able to write off that asset quicker for tax purposes. Whenever people talk about things and you probably just gloss over with your eyes whenever they get on the news, they talk about, well, Congress and the president wants to, you know, change tax laws to have accelerated depreciation on assets. And you're just like, who cares? Well, accelerated depreciation means you get to write off that asset quicker for tax purposes, meaning you're going to spur all sorts of companies, investors to spend money now, buy equipment now, to do improvements now, because they're going to get the tax benefit now, as opposed to having to wait for it and have it amortized over multiple years. Does that make sense? Tax policy drives behavior in many cases. You're saying, well, I don't really think about it. You maybe don't, but many companies and high net worth individuals do, because it can mean hundreds of thousands of millions of billions of dollars that they're going to be responsible for. I mean, one of the other big things, I'm not trying to get off on a tangent here, but one of the big things that obviously we're talking about in terms of tax policy change is what? About repatriation of funds for international multi-conglomerate, you know, companies that have done what? They have parked their money overseas and they refuse to repatriate it back to the U.S. because the tax laws here would cause them to have to spend too much in taxes, and so the money never re-enters our economy and stays in the bank in somebody else's economy. Apple being one of the biggest. They've got billions upon billions of dollars of money sitting basically in China that they refuse to bring back to the U.S. to potentially be spent in the U.S. on anything. They don't really need to, but they would if tax laws were changed and the tax rate that they would be charged would be less. Does that make sense? The reason in going into that is just simply to say, tax law drives behavior, okay? Whether you like it or not, it does. Now, I will agree, in many instances, it's a boring subject, but you know, the thing about it is, it's an extremely important one, and it's a very complicated one. We have entire degree programs, not only at this university, but all across the country, where you actually here at Nova, you can get a Master of Science in taxation. An entire master's degree in nothing but taxation. Does that not blow your mind? That tax policy is so complex that it would require you to have an entire degree program dedicated just to trying to understand it and be able to apply it?
When does the year start, the depreciation year start?
It starts in the first year, but we're going to talk about mid-month convention, okay? Trust me, we're getting there. Okay, but my point is that tax policy is a very complex one. They can all be theoretically done, they can simplify it. But we've chosen not to. This is not a political thing, this is just simply a matter of fact. Over the years, we've made it incredibly more complex to where you have to have somebody effectively with that level of education to understand it and be able to try to glean the best benefit, possible for you as an individual or as a company. Okay. So depreciation, once again, we're going to do the calculations. We're going to show you how you get there with this and what this really means. But depreciation, what it actually means, is as follows. It's meant to represent the useful life of the asset. That's what it's meant to represent, is the useful life of the asset. So what the IRS is basically saying is that we are going to allow you, on your income taxes each year, to write off a percentage of the value of that asset for this particular period of time. So in other words, this number, this depreciation number, for residential properties is going to be 1/27th of the property's building value. Now you notice I say building value and not total value, because you don't depreciate land, okay, which we're going to get into as well, all right? So 1 divided by 27.5, you're going to be able to depreciate that percentage of the property's building value each and every year for 27.5 years, okay? All right, so we subtract those out. That gives us now what the IRS is saying, this is now your taxable income. This is the income that we're saying we're going to base our tax rate off of, because this interest expense and this depreciation. All right, now here's the thing. And this is the part, once again, that begins to blow your mind. Is this depreciation an actual check you're writing to someone? No. You're like, what? You're not actually writing a check to anyone for this depreciation. It is simply an allocation that you are being awarded by virtue of the tax policy. Does that make sense? Okay, it is merely being used for the purpose of helping you to calculate your taxable income. So no check is being written here for depreciation to anybody. And then for the interest piece, the actual real check, if you will, that's being written is for the overall annual debt service. So this is the portion of that, okay? So once again, that's what I'm saying. This is the tax world. We're just focusing on the tax piece. All right, so we subtract those out to give us what the taxable income number is going to be. You multiply that by the tax rate. Now, the tax rate. This is one of those sorts of things. Congress changes every so often, okay? And there are different tax rates, whether, like if you're an individual, whether you're obviously a married couple, or whether you are part of a partnership, or part of a corporation, or part of a limited liability company, or part of some other entity, tax rate is going to be different, okay? And the tax rate in many cases that we're going to use is like around 28%, but we'll talk more about that a little bit later. Okay, so we subtract out, we take our taxable income, we multiply by the tax rate, that gives us the taxes payable. Now, we've gone through all of this brain damage here just so that we can calculate that taxes payable number, and we subtract that because that is a check that we're writing. We're writing that check, the taxes payable check, to who? The IRS.
It is an LLC though, it will pass through to the rest.
And that is another piece that we've got to deal with a little bit later. Okay? So, in this case, before tax cash flow, we write a check to the IRS for the taxes payable, and we get the after-tax cash flow, but now is the money we have left over that we can now distribute to ourselves and everybody else. Okay? Make sense? Okay. Now, let's do some calculations with this. Okay. Let's say that we bought a property, and the price of that property, we're going to try to keep this simple, $1 million. Okay? Now, that is in total what we have paid for the property. All right? You remember what I said a few minutes ago. You get to depreciate what portion of that? The building, okay? The improvements, okay? Because with each property, as a general rule, we have land and we have improvements. If you go and you look, for example, unrelated but yet somewhat related, if you go and you look at the Broward County tax assessor's site, now that's property taxes, but if you go and you look at that, what do? They break it out and they say, here's how much is attributed to the building or the improvements, here's how much is attributed to the land. Yes? Okay? So, in this case, that is one source that the IRS allows you to use, is the local property tax authority to determine what that percentage is going to be. So you would go to like the Broward County website and you would say, pull up this particular address, and you would see, okay, the overall value that maybe they have is $1 million, but they're saying that the building or the improvements are worth $800,000, and then the land is maybe worth $200,000. Well, obviously those two add up to the million. Does that make sense? Okay, so we're saying 80% is improvements, 20% land. Okay? Now, if you're paying attention, what is your depreciable basis for this property?
800.
800,000. Yes, you got it. Okay? Your depreciable basis for this property is 800,000 because you're only able to depreciate the improvements value. Now, once again, we enter the tax world again. Why is land not depreciable? It doesn't go anywhere. Supposedly, barring a nuclear holocaust, it's indestructible, it's forever, it's permanent, it's blah, 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 blah. Okay? Now, and, you know, so, with, like I said, with a few weird little categorical exceptions, you can reuse the land over and over and over again. Yes? Okay, you can tear down a building, build a new one. Tear down that building, build a new one. So forth, so on, we can get our head around that. Now, as I said, a few categorical exceptions might be, you know, some sort of a, you know, radioactive site, might be a graveyard, might be it's underwater now, might be, you know, those sorts of things, yes, would destroy the land value, but for the purposes of the tax world, we're not concerning ourselves with those, and we are simply looking at what is the depreciable value of the improvements. Okay, everybody cool with that?
And who determines that value?
What about what?
And who determines the approval value?
That is, once again, you can either use what percentage allocation that the local property tax authority, you've got three different ways you can come to this valuation, okay? Number one way is to use the allocation that is given by the local property taxing jurisdiction is way number one. I'm just even writing this stuff down. Way number two is by virtue of the contract that you had, the purchase contract on the property, and if it was delineated within the purchase contract and you said, of the $1 million purchase price, 800,000 we're allocating to the improvements, 200,000 we're allocating to land. Number one is the local taxing jurisdiction and how they have split up the allocation. Number two is how it is in the purchase contract. Number three is you hire an independent appraiser, and that independent appraiser comes up with the allocation. So, in essence, those are the only three ways that you can come up with this number. Now, which one of those can you easily manipulate?
The local jurisdiction.
No. The one in the contract. Because the appraiser, they're going to, hopefully, if they're doing their job, they're going to be objective and realistic and rational about it. The local taxing authorities can be realistic and rational about it. But you, whenever you buy the property, if you all of a sudden put some crazy numbers in there that are going to inflate one or the other for your own nefarious purposes, they're going to look a little bit more skeptical at that. And you're saying, what do you mean, inflate? Well, what are you going to get more value for tax purposes?
More improvements than land?
More improvements than land. So theoretically, you could say, whenever I bought this property, I'm attributing 100% of the valuation to the improvements, 0 to land. The IRS is going to look at that and put a big fat no, okay? Now, if you had maybe allocated 5%, the IRS, if they chose to audit you, they would say, well, wait a second, all of the other properties within this area are using something closer to 20%, you're only using 5%, we're probably going to, boom, not going to allow that. You know, and on the flip side, well, if you maybe put the land value as 50%, they may not have a problem with that because there, quite frankly, you're paying them less tax. But now, but if they do the audit, they're still going to probably come back and say, well, on average it's 20%, so you probably ought to be somewhere close to that. You follow? And that's another thing. Everything is okay until you get audited. Okay? In the sense of, you can make whatever assumptions you want to make. But once an audit starts, the audit is going to go, and the audit is looking for reasonableness of things. The reasonableness of the assumptions that you're using and your justification for